It has never happened before that you had a triumvirate of bubbles in stocks, bonds, and equities. But bubbles are, they can exist for a long time. I mean, people were talking about bubbles in 96 and 97. Alan Greenspan says, irrational exuberance. They can continue for years, but then they always burst and they always mean revert. But this time you have to mean revert home prices, equity prices, and bond prices. Bond prices really, I mean, if you look at things like high yield bonds, the spread to treasuries is just about as tight as it's ever been in history. And then you have things like collateralized loan obligations, and you've got new things like private credit. But, so if you can't get a loan, if a business can't get a loan from the bank, and they're highly leveraged, and they can't even float debt in the corporate bond market, they just, go to like the shadow banking system and say, hey, here's some debt, finance it at a very low interest rate, and you can't get out of it. You don't price these. There's no pricing mechanisms for these bonds. It's private. So that means you're locked in. There's no liquidity. I mean, this is a big problem that we have once the recession hits, and there will be another recession. The yield curve, by the way, just normalized in December. That's not too long ago. And it usually takes around 3 to 6 months after the yield curve normalizes before you see a recession. And we had the longest inversion of the yield curve in history, and it was the second deepest inversion in history. The spread between the 2 and 10 year note. So I don't throw out my theory that we're in for a lot of trouble. I mean, I invest money for clients. We had a positive return in 2024. So it's not like I'm sitting here shorting the market. I'm just warning people. I'm not a Cassandra. I'm just warning people that this is the most dangerous market ever. Look at valuations, have never been this extreme. If you look at things like price to sales or total market cap of equities to GDP, or if you look at earnings yields, so the risk premium, earnings yields minus treasuries, it's zero, if not negative. So what I'm doing right now is I'm only slightly long the market. I have a slightly net long position, about 15% long the market with hedges. In the portfolio, I have a tremendous amount of bonds on the short end of the yield curve. I think whatever's left in this bull market is not really worth the risk of being overly long in this. First of all, if you were in the 60-40 portfolio, think about 2022. So 60% stocks, 40% bonds. And that, by the way, that reverses as you get older, where you could have, say, 30% stocks and 70% bonds. If you look at long duration bonds, they are down 50% since 2020, 50. So your return on a bond fund that's out along the yield curve, you've lost half of your money, not in Bitcoin, not in Fartcoin, not in some pink sheet stock that doesn't trade. In U.S. Treasury bonds, you lost half of the value. So I think 2025 could look a lot like 2022 when you see these bubbles burst. For the timing, I rely on my model that I created. It's not time yet. It's not going to happen, on Friday, I don't think. But it's definitely something that's going to happen soon. And when it happens, it could bring down both bonds and equities concurrently. Along with real estate, it could be very, very dangerous for the 60-40 buy and hold portfolio. So I would maintain an extreme flexibility and have a robust model, an algorithm that lets you know when to get out of harm's way, when to go into short-term treasuries, when to go into cash, when to go into the dollar, which, by the way, the dollar's been working spectacularly if you're long the dollar. So that even could get even worse. As far as the appreciation of the dollar, and you must be able to short the market adroitly. And that's my plan. Well, there's a letter called, I think it's the Kobayashi letter, to put out a very good stat. The leveraged long positions in these leveraged ETFs are 100 times greater than short ETFs. So that's why there's no margin, but there's a lot less margin debt on the NYSE. You don't have to have a prime broker and borrow in a type 3 margin account, short them, and come up with money and pay interest and all this. You have to pay the dividend. You could just buy a leveraged ETF if you want juice in the market. So it's belying the fact that there's a lot of leverage out there, and it's all these leveraged ETFs, and 100 times more than you find in the inverse ETFs. So that means I don't care what sentiment says, the fear of missing out, the FOMO, and the speculation in the stock market has never been greater in the history of my 34 years of being a licensed professional. And that means it's just a tremendous amount of downside. And you think people say, I hear it over and over again, Donegan. They say on the mainstream financial media, well, don't worry about it because the government and the Fed has your back. If we have a downturn in the economy, or if we have a hiccup in the stock market, or home prices start to fall and bank assets start to come under pressure, we'll just cut interest rates. Well, the funny thing is, the Fed is in an interest rate cutting regime. You know that, right? They've cut interest rates by 100 basis points, and every single part of the yield curve has seen bond prices fall and yields go higher. Every single part. And mortgage rates are up 100 basis points, 1%, since the Fed decided it was a very necessary move to cut interest rates, because they understand. Don't listen to me. Listen to Jerome Powell. He gets it. That's the reason why he's cutting interest rates. He's cutting interest rates because the Treasury cannot afford interest, $1 trillion plus interest on the national debt. And they see bank assets are coming under extreme duress here. And so he's trying to get the borrowing costs of the consumer and for corporations down, but it's the exact opposite that's happening. I don't care what he's doing. Borrowing costs are elevated. Interest rates are rising. The interest rates in the United States are the highest in, I think, 18 years. 18 years. And it's not just the United States. In the United Kingdom, they're the highest since 1998. So we have a global revolution in the corporate and sovereign bond markets. That's just the nascent, that's the beginnings of these tremors. And when you have rates that are rising on a record amount of debt, we have a record amount of total non-financial debt as a percentage of GDP is at an all-time record. So there's a tremendous amount of debt out there. And when you see rates rising on that debt, and the debt was used to engender these asset bubbles that I just talked about, stocks, bonds, and real estate, you have the most dangerous cocktail we've ever seen. So please, I hope your audience is in the millions. And but if even there's an audience of like 2, I know you have a very high audience. I'm not deriding your audience. Your audience is growing and it's very vibrant. I'm saying I wish that you had. I could tell everybody, because I've been thrown off the mainstream financial media. Everybody needs to know that if you're in these target date funds, these buy and hold funds, you are going to get slaughtered if you don't take measures in your own hands to just get ready to protect yourself. Now, I'm looking at national, I'm looking at total, I'm looking at financial conditions, and I'm looking at credit spreads myopically to let me know, not when I think it's time to worry, not when I had a bad dream last night, not when somebody on CNBS says, hey, you know what, I think the 200-day moving average is in jeopardy here, but it's going to be support. I need to know the arcane components of the market that I look at in my 20-component model that let me know when the big boys on Wall Street, the insiders that know what's happening with the CLOs and the private credit, when they know that their assets are deteriorating and the cash flows are going dry, when they know before anybody else will come on CNBS and tell you, they start selling, they start buying insurance, like they start buying credit default swaps, and that sends the financial conditions index higher. And you'll see people selling junk bonds and heading into treasuries. The insiders, the people that know, that's where my fingers are on the pulse of. And I will take actions because I think that the danger in this market is going to be like we've never seen before. And I'm not trying to use hyperbole here. The reason why I say that is because we do have record asset prices. That's a fact. But what I'm most worried about, and by the way, before I make the statement, we've had bubbles in real estate before. The real estate prices dropped by 33% nationwide. The Fed cut interest rates to zero and fixed the problem eventually, right? The stock market has fell apart in the global financial crisis. It fell apart in 2000. From 2002, it lost 50%, the S&P. But the Fed was able to come to the rescue eventually. Not that you losing 50% for a few years isn't a problem. It's a problem. But the Fed was able to fix everything by what? By lowering interest rates and printing a bunch of money. It's not a guarantee, but there's a very significant risk. And it was in my model. I predicted it. It's happening. Doesn't mean it's going to continue to happen. It's not guaranteed to happen. But when the Fed lowers interest rates next time and the economy experiences a problem, the insolvency condition of treasuries and the fact that inflation is still salient in the minds of investors. We haven't returned to 2%. We're no longer growing at 9% inflation. We're down to 3. Congratulations, but you've already bankrupted the middle class. But it's a combination of inflation and insolvency, because I think deficits can go to $6 trillion. The annual deficit can be $6 trillion in the next recession, just based on the last 3 recessions and the percent increase in the deficit. $6 trillion. You could have bond yields spike even in a recession. And even if they don't spike, they might not come down, especially on the long end of the curve, the way they usually do. I mean, the Fed controls the short end of the bond market. I'm not saying that they can't lower the Fed funds rate to 0. They'll be late to the game. They'll be reticent to do it because they know what happens. They already know what the inflation is going to come, and they don't want that. But they'll eventually have to do that because, if the choice is inflation or a depression, they'll always, every central banker, not just the Fed, they'll always choose inflation. It's just much easier to lie about and hide. But when you talk about the total, bankruptcy of the financial system vis-a-vis, intractable inflation, they'll always choose intractable inflation. And that, I believe, will cause yields to spike to levels even higher than they were in 1980.